Section 4. Unit 2, Federal Legislation Affecting the Real Estate Industry. Introduction and Objectives. Lesson 1, Overview of Federal Legislation Affecting Real Estate and Mortgages. Lesson 2, the Truth in Lending Act, TILA. Lesson 3, the Real Estate Settlement Procedures Act. Lesson 4, ECOA, HMDA, and CRA. Essential information about RESPA. The Dodd-Frank Wall Street Reform and Consumer Protection Act, the Dodd-Frank Act or simply Dodd-Frank, was created in response to the 2008 subprime mortgage crisis, which impacted national and global economies. Dodd-Frank was established in part to provide stricter regulation and oversight of the financial services industry. Key to this mission was the creation of the Consumer Financial Protection Bureau, CFPB, which promotes fairness and transparency for mortgages, credit cards, and other consumer financial products and services. The CFPB enforces the Real Estate Settlement Procedures Act, RESPA, and requires that consumers receive disclosures at various times in the transaction while outlawing kickbacks that increase the cost of settlement services or limit consumer choice. History. In 1968, the Federal Reserve Board, FRB, enacted the Truth in Lending Act, TILA. The regulations within this act are known as Regulation Z, Reg Z. When TILA was enacted, the FRB administered Reg Z, but since 2011, the CFPB has overseen it. TILA requires that lenders disclose the annual percentage rate, loan terms, and total borrower costs before extending credit to borrowers. Separately, the U.S. Department of Housing and Urban Development, HUD, implemented Regulation X, which in turn implemented the 1974 Real Estate Settlement Procedures Act, RESPA. Regulation X is administered by the CFPB under the Dodd-Frank Act. The Dodd-Frank Act. In 2010, the Dodd-Frank Act went into effect, which changed previous RESPA and TILA requirements. Congress put both acts under one umbrella and made the CFPB responsible for RESPA and TILA. Lender disclosures required under RESPA have been combined with disclosure requirements under TILA. Together, these disclosures are called the TILA/RESPA Integrated Disclosures, TRID. The TRID forms are the loan estimate and closing disclosure, which lenders are required to provide to borrowers at specific times. RESPA also outlaws kickbacks that increase the cost of settlement services or limit consumer choice. Under these provisions, lenders must disclose the following information to consumers: the loan type for which they're applying, all loan fees, a projected payment table, estimated closing, settlement, costs. Why does it exist? HUD enacted RESPA, a consumer protection statute, to protect consumers against abusive lending practices and ensure timely and accurate disclosure of settlement costs. RESPA helps homebuyers be better shoppers and eliminates illegal kickbacks and referral fees among settlement service providers, that's any entity providing services related to the settlement process, like mortgage brokers. For instance, a mortgage broker might pay a real estate licensee a fee for every client sent to the broker. This is illegal under RESPA because it limits consumer choice. The licensee would likely not offer referrals to mortgage brokers that don't provide referral fees, and increases consumer costs. The mortgage broker would add this cost into the consumer's fees without identifying it or disclosing it to the consumer. RESPA does permit licensees, through their brokerage firms, to offer cash rebates of licensees' commission to buyer and sellers as long as no part of the rebate is required for referral of business. RESPA requirements apply to all settlement service providers, including real estate brokers, lenders, title companies, appraisers, closing attorneys, surveyors, etc. How does it affect real estate sales? RESPA regulations apply to federally regulated loans on 1 to 4 family residential properties, including assumptions, refinances, home improvement loans, and home equity lines of credit. RESPA applies to any loan made by a lender that's insured, regulated, or guaranteed by the federal government or HAT will be sold in the secondary mortgage market. That is secured by a lien on a residential real property on which a 1 to 4 family dwelling is or will be constructed or placed, in the case of a manufactured home, within 2 years of settlement. Loans secured by residential rental or investment properties may be excluded from RESPA under the exception for business purpose. RESPA does not apply to loans for commercial, business, or agricultural purposes, even if residential property is included. RESPA requires that the lender provide the borrower with a written disclosure of estimated settlement costs. The loan estimate form itemizes these costs at the beginning of the application process, and the closing disclosure form, which provides a precise accounting of costs, is used at closing. When and how will a real estate professional encounter or be obliged by this Act's requirements? RESPA applies to any residential loan transaction that is federally related. If the loan is commercial, RESPA doesn't apply. And if the transaction is all cash, RESPA doesn't apply. But for most residential purchases that are financed through a federally insured financial institution or that are using a federal agency, such as Fannie Mae, RESPA applies. Loans exempt from RESPA include commercial or business loans, vacant land, agricultural land, land tracts of 25 or more acres, with a residence or not, certain kinds of loan assumptions, construction-only loans, loans to the government. When lenders discriminate. In your parents' time, and certainly in your grandparents' time, obtaining a fair loan on a home was often dependent on the color of your skin or whether or not you had an accent. Hard to imagine, yet true. Discrimination in lending was rampant and was practiced not just on an individual level, but on a systemic level as well. Consider the following hypothetical, but quite common, scenarios. Ricardo and Rita want to buy a home in the neighborhood where Rita grew up. They've saved for years to get their down payment, and their credit is stellar. But when they apply for a loan, no lender will extend credit due to the Hispanic makeup of the neighborhood. Jerry and Missy are meeting with a lender, attempting to obtain a loan on a new home that's come up for sale. The lender is all smiles until he learns they're Jewish, and then suddenly he has a meeting to get to. He doesn't return their subsequent calls. At ABC Bank, the bank manager shows a map of the city and draws a big red circle with an X across it. No more loans in the Garden View neighborhood. It's overrun with minorities. Susan goes to apply for a loan. Her income history is great and her credit is top-notch. However, the lender says that without her husband's signature, he won't grant the loan. The Lees, a Chinese-American family, find that the loan terms they were offered by their lender are much less favorable than those offered to their neighbors, a Caucasian couple, who have similar credit and income. Yes, these scenarios, or some version of them, used to happen frequently, effectively eliminating the opportunity for homeownership for segments of the American population. In response to these inequities, activists and members of Congress worked together to develop legislation to combat such discriminatory practices. Laws enacted by Congress as a result included the Equal Credit Opportunity Act, ECOA, the Home Mortgage Disclosure Act, HMDA, the Community Reinvestment Act, CRA. The legislation was designed to require lending institutions to do more for their communities, be transparent in their lending practices, and no longer engage in discriminatory practices, such as redlining, racism, and sexism. Essential information about ECOA. Why does it exist? The Equal Credit Opportunity Act, ECOA, was a response to discriminatory practices by lenders that made credit unavailable to people or offered less favorable terms based on protected class status, and not on their credit worthiness. What's its purpose? ECOA prohibits creditors from discriminating against protected classes or asking for certain types of information. The intent is to make credit equally available to all credit-worthy applicants. Protected class status includes race, color, religion, national origin, sex/gender, marital status, age, over the age of 18, or dependence on public assistance. How does it affect real estate sales? Lenders and real estate professionals who arrange financing must follow the requirements of the Act. The ECOA valuations rule requires creditors to disclose to applicants that they have the right to receive copies of appraisals and written valuations, and to automatically send a free copy of home appraisals and other written valuations promptly after they're completed, regardless of whether credit is extended, denied, incomplete, or withdrawn. The rule applies to all written valuations, not just appraisals, developed in connection with an application for a covered transaction. It covers all first liens on dwellings, including closed-end mortgage loans and open-end loans. When and how will a real estate professional encounter or be obliged by the Act's requirements? You should be aware of the rules, and notify your clients if the rules have been broken so they can pursue legal remedy. Other notes. This is also known as Regulation B, implementing the rules of the Act. This act was amended by the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010. It is currently enforced by the Consumer Financial Protection Bureau. Essential information about HMDA. Why does it exist? The Home Mortgage Disclosure Act, HMDA, of 1975 was created when it became clear that some financial institutions had contributed to the decline of certain geographic areas by failing to provide adequate home financing to qualified applicants with reasonable terms and conditions. What's its purpose? The key purpose of HMDA is to provide the public and elected officials with sufficient information to enable them to determine whether financial institutions are fulfilling their obligations to serve the housing needs of the communities and neighborhoods in which they're located. HMDA requires many financial institutions to maintain, report, and publicly disclose information about mortgages. This helps public officials make decisions and policies, and it reveals lending patterns that could be discriminatory. How does it affect real estate sales? HMDA, when applied correctly, opens up sales opportunities throughout a community, and not simply in affluent, predominantly Caucasian sectors. When and how will a real estate professional encounter or be obliged by the Act's requirements? Licensees should be aware of the program, and investigate and report if it appears that a neighborhood is being redlined. Other notes. Currently, the Consumer Financial Protection Bureau has authority over HMDA. Initially, HMDA reporting requirements only included the number and dollar amount of loans by census tract. In 1989, the Financial Institutions Reform, Recovery and Enforcement Act, FIRREA, expanded the data lenders are required to disclose. Lenders must now identify the race, gender, and income of loan applicants, as well as whether an application was accepted or denied. Essential information about CRA. Why does it exist? The Community Reinvestment Act, CRA, was created in response to the practice of redlining. What's its purpose? CRA requires lenders to meet the needs of their communities by investing in development and rehabilitation efforts, especially those that enable low and moderate income individuals and families to afford a home. Lender compliance is reviewed through the lender's report that shows its community's geographic boundaries, identifies the community reinvestment credit offered, and includes comments from the public about how the lender is doing in meeting the community's needs. Periodically, the lender is reviewed by a federal financial agency, such as the Comptroller of the Currency, the Federal Reserve's Board of Governors, the FDIC, or the Office of Thrift Supervision. The lender must post a public notice that it's subject to this review, and make the results available. How does it affect real estate sales? If you've noticed the rehabilitation of a community in your area, you may have this act to thank. It's helped to reverse the trends of deteriorating neighborhoods in many instances. When and how will a real estate professional encounter or be obliged by the Act's requirements? Requirements affect lenders only. Other notes. This act is not without controversy. It's been revised numerous times since its inception, and its effectiveness has been called into question, and there has even been speculation that it may negatively impact some communities. Some have argued that it forced banks to make riskier loans and thus helped to create the situation that led to the housing crisis. Such claims have not been substantiated, however. Essential information about TILA. Why does it exist? The Consumer Credit Protection Act, CCPA, created in 1968, includes the Truth in Lending Act. The intent of the legislation was to safeguard the consumer in the use of credit by requiring full disclosure of the terms and conditions in any offers of credit.